Now we want to look at what's happening in the U.S. because we talk so much about the different shifts on, what is happening at the balance sheet level when you look at the Fed, and how is that going to impact not only just growth but also inflation? Because as we've said, and just as a reminder, the Fed has a dual mandate. It's full employment and inflation. So when you look at where we are right now in terms of full employment, we're either out at or very close to, but inflation is well over their estimates or what their expectations are and guide is. And that's when we start looking at when are they going to start selling down some of their balance sheet. And I know that there's questions out there of will they do it? I think they will try to sell down some of this balance sheet and not just let things mature. As they mature and they don't renew, that'll be a natural roll off. But I actually think you're going to see a bit more aggressive activity, but closer to the end of the year. I don't think they're going to do it up front because we will get some activity. And then the question is, what is their increase in basis points going to be next week? I've always been that it's going to be 25 basis points. I never kind of believed the hype that it was going to be 50. I understand why people think it could be. And if it is, I don't know if I'd be all that surprised, but I think they want to be very consistent of 25 basis points and again, trying not to spook the market too much as we continue to see these increases as they try to bring things under control. But when you look at what the expectations are, you get an idea of where the implied curve is telling us on where the Fed funds is going to settle out. And the question is then, what is the neutral rate? And, I've had some great conversations with people, and I would argue that the neutral rate for them, as you can see, it's always been moving down, is about 2.25%. Maybe if you want to make an argument, it can be 2.75%. But I definitely think it's below 3% at this point in terms of that neutral rate, which is just where they'd be comfortable sitting at and holding steady. But, is that going to be something that breaks the market? Because we've gotten so used to under 1% that anything above 2% is just soul crushing. So this just gives you an idea of what those expectations are in terms of where the rate could be by the time we get into next year. But when you think about why are they doing this? And, one of the things that and we've learned this from the 70s, the Fed lost control of rates and they were kind of flailing around, trying to adjust different things, trying to do what they could to get rates back under control. And they just never really got there. And it was because people lost confidence going into that, because for the most part, it is a confidence game. And then you obviously have to back up what you're doing. So when you look at losing the control of rates, they inherently lost control of wages. And that's something that they're trying to adjust, because even though it looks like weekly wages are going up, you have to look at real wages. When you factor in inflation, you are getting this pressure, which is going to continue to hit the market, as we're going to discuss as well in the next segment. So then when you look at, again, that median wage side, so inflation adjusted median wage growth ticked up in January, still deeply negative. And then when you look at some of the leading indicators, U.S. Philadelphia Fed Manufacturing Index came in well below estimates. That happened in the Empire as well. We're going to talk about that. But you're getting an idea just where the pressure is and why that first chart becomes so important as they look to find ways to essentially steady out sticky inflation and keeping things essentially, again, bringing down that flexible while trying to manage the increases that we're going to continue to see on the sticky side, which again impacts living costs and living wages so much. But when you look at the failures that we've seen throughout time, it's price controls. And we've heard it thrown around, so we wanted to tackle this head on. Price controls during World War II had buy-in. You had people that were saying, this is for the boys, we're doing this for the men at war. You didn't have that same buy-in in the 70s, and it reflected as such. And that's where any type of price control would be massively mismanaged and create so much additional pressure that it's not something that I think would be a rational move, even though it's always talked about as a quote-unquote solution. we're not going to have buy-in. That's just not how this market sits. That's not how the U.S. consumer is, especially in an entity where we want it now and we'll pay up to get it. I mean, that's why Amazon exists the way it does, the way Instacart, price controls takes that away. Because if it's not price sensitive, then if it's always going to be the same price, people will come in, they'll hoard, and you create this negative feedback loop, which we think would obviously come back in tenfold versus what it was in the 70s. But when you talk about inflation, people still think it's transitory, and only 39% think inflation is permanent, while 52% think it's transitory. So, and this is just looking at a majority of fund managers. Now you're seeing that the pivot is there. People are starting to think it's a bit more permanent. The issue is how do you measure it? Because when you look year over year, it's going to start getting better because we had inflation running rampant by the end of last year. Now, we know that inflation has been up since then. We've had, many months of continuous increases. But as the rate of change slows, is inflation going away? And for me, if inflation isn't permanent, we should get deflation. So the question really should be, how many investors think there's going to be deflation? And if the answer is the same, then I agree. Then they could say, okay, it is transitory. Again, what your time frame on transitory is another definition we can discuss. But if people think it's actually deflationary and we're going to see this backdrop, then you can hold to this view. My view is that we go in from an inflationary standpoint into a stagflation, and I do think we get deflation. I think it's either a Q4 or Q1 event, but I also I think we're beyond the transitory definition. So again, it all comes down to semantics at that point and where that pressure resides. But one of the things, we saw it with 3M, we've seen it with a lot of the consumers side, the S&P 500, when you look at guidance is being revised, guidance revised up is declining as we're getting more revisions down, as margins are getting hit. You're getting that wage compression. The wage hits because the cost, you're trying to increase wages, but your cost of doing business is going up, input costs. All of these things are, again, eating into margin and causing for that revision down. And it just looks into, well, what is doing it? Well, higher costs are cutting into profit margins, and we don't see this stopping anytime soon when you look at compensation changes, planned price increases. And the problem is you're having reported price increases going up, but the ability to increase prices is starting to slow. And that disconnect is margin, because when you can no longer pass on that price, that's when you start to see some of those pressure points. And obviously, when you look at labor costs, inflation, you can look at just how big that has come, where labor and inflation continue to be the biggest drivers of problems and price increases over that time period. But again, when you look at U.S. consumer sentiment, it is going through a floor. We're below where we were during the COVID period. And then when you look at U.S. retail sales, you can see that retail sales, again, have gone up. But look at how measured they are. It's not like we're getting this big surge up when you factor in the idea that prices have increased on an average about 7.5%. So if you think about prices going up, did we cover that? And the answer is no. So even though the value went up, the actual volume didn't. And that's the underlying problem, where how much of that value is compensating for the loss in volume as the cost of doing business is going up, which is why it's important to dig in more on where retail sales actually shake out, which is when you look at goods versus services. So one of the things is commodities, less food and energy, services. You're seeing all of this going up on a core level. So core goods have been clear driver of higher CPI during the pandemic. January was 11.7% year-on-year increase, fastest since April 1975. And the main difference between now and the 70s and 80s is that core services not seeing a similar spike at the same time. But we think that's catching up, because remember, this calculation is always kind of a moving needle. And they changed the way the calculation was struck in, I think it was 83 or 84. And that, again, adjusted some of those pieces. So there's still a lot of this inflation. And we do think that the sticky side, again, is going to continue to catch up. And here's some of the reasons why. Small business higher prices, giving an idea of where prices are. And then the small business poor sales, single most important problem, is continuing to become a bigger issue as the higher selling prices have not hit aggregate sales yet. But there's a growing concern that we're getting to that point and you're getting consumer pushback. So inflationary pressures are hurting small business psyches and causing them to raise prices. Record percent as shown by the blue line, yet only 4% of small businesses are citing poor sales as most important problem. Now, one leads to the other. So again, the inflation is kind of that leading edge, and then the sales side becomes a problem as consumers push back. And again, there's pushback on two different ways. You find alternatives that are cheaper, or you just reduce your volume in total, and that's something that we think is going to be more of a Q2 event. It's going to be continued through Q1, which will then put a bit more in inventory as retail sales, continue to kind of see that steady slowdown, and you see that build up in inventories. Now, when you look at U.S. small business scale back inventory build, they're not looking to build at this price. So they're trying to manage inventories. They don't want to lock in these high prices because then you have to try to pass it on. And they're trying to manage inventory as they also are concerned about where are sales going to be. Because if sales slow, you're going to have a natural build in inventory, and they're trying to manage that so that you don't see this huge increase. Which is why when you start, why are we saying this? Because inflation is eating into those wages, and inflation in rich countries hits a 25-year high. This is not just a U.S. problem. This is a global issue that is continuing to eat into that global growth, which is why we see some of these slowdowns and the pressure when we start talking about oil demand and other economic metrics when we measure abroad. So then as we go further and we look at, again, what are the contributions, contributions of reopening to non-reopening? Well, non-reopening components were 4.2%, while reopening was 1.6%. So the view was that as coronavirus goes away, COVID goes away, inflation will moderate. Well, it's not, and it's shifting gears, and that's why now you're starting to see some of this, and I don't want to say panic, but this change in rhetoric where you're going to see an accelerated amount of activity in terms of trying to bring this under control. So wage growth tracker by occupation, you're seeing that the occupation, and this was an interesting way to do it, looking at, because you can go from low wage to medium wage, depending on how prices change, but this is looking low skill will stay low skill. And that's where you can look at some of the shifts. So as we've seen, wage growth continues to go up, but the low skill, even though if you were to look at the low wages, has accelerated, but when you look at it in terms of that pivot, it's still staying under pressure and it's still not keeping up. And it's starting to a little bit, but you're seeing that pressure side where you can get a kind of a misleading backdrop in terms of where some of the capacity is and why some of the problems are going to arise, hitting the lowest common denominator when you're talking about spending. And the unemployment by education is kind of pushing that again, where you're seeing the less than high school struggling to get jobs, that employment's actually falling, and they're not getting the wages that they need for that living wage, which we're seeing again when you look at cumulative excess savings. Everybody likes the big number, but then when you break it down, you can see that it's all very much top weighted. So you have a large swath of the US population and really global population that doesn't have the excess savings the headline numbers predict, which is why when you look at the leading indicators of US personal consumption expenditures versus the PCE five-year average, you're going to have that pressure and that weight bringing it back down. And then inflation and lack of skills are to blame. When you look at the quality of labor, still remains a big problem as inflation rapidly catches up when you're looking at where there's going to become a bigger issue, which again is going to lead into slower sales. And that's not something that I think is a big surprise. Now, when we look at why the Fed is starting to talk even not only just stopping QE and raising rates, but more aggressively selling down their balance sheet, it's because the percentage of all CPI components of the 250+% growing at 2% year on year, we're at 90%. We're at a level we haven't been at since the 70s for the amount of things and types of things that are seeing price increases. And the problem is we have exported a lot of manufacturing And we import a lot of those problems, which is why we talk so much about the global backdrop. And then this puts it in a little bit of a different perspective where inflationary pressure is broadening out. 90% of components are increasing above 2%, which is that blue line, and almost same share are above their 5-year average. So you're getting an idea that this is not just a small blip, but a consistent piece, which is why we don't see this big drop off, but rather just this kind of staying elevated and leading into a little bit more inflation through June, and then seeing that stagflation really kind of pick up in the summer months. All the while, when you look at the February manufacturing data, February Empire manufacturing came in at 3.1% versus the estimate of 12. And new orders back into positive territory. Prices received jump. Work week still expanding. Delivery times unchanged. And shipments ticked up slightly. Employment still strong. So again, you're still seeing some expansion, but just look at how we're bumping along the bottom, and prices received continue to jump, which again, pushing through that price. But as that slows down, that's when we think you get that accelerated slowdown, which is going to weigh on some of these leading indicators. So then when you, again, just looking at it a bit differently, you can see just how we're bumping at the bottom. New orders, slightly expansionary. So we were slightly negative. Now we're coming back to that level. And this is what gives us that confidence, because you're seeing the Empire State Manufacturing new orders, that type of number playing out on not just on across all regions, and not only just in the U.S. but abroad, which is why we see minor growth. Like we're talking about something that is leading indicator for where growth is going to be over the next few months. And then prices paid, again, flatlining as prices received gone higher. And this is, again, that prices paid is giving us that confidence on that stagflation side. And then obviously the prices received is where you're trying to pass some of that on. But look at the difference. Prices paid at about 75, prices received at about 55. So you still have some of that gap that they're going to try to close. And a lot of that is margin. And then when you look at just the dollar index, you get an idea of where the dollar index is and that CPI, which is why we do expect to see some of that movement, especially as the Fed tries to protect rates and the dollar. Now, we don't think the dollar surges. We think it's between 95 and 97, and there's going to be some play within that as the commodities and the general world has kind of shifted away and has kind of broken the normal correlations with the dollar, where we do think there's going to be a bit of a snapback. And the CPI inflation is running at its fastest rate since 1980s, but difference these days is much more muted moves in the dollar. The greenback has not collapsed, unlike stagflationary errors a decade ago. So again, they're going to want to try to protect the dollar and protect rates, and that's going to create a very interesting dynamic, to say the least, over the next really the next few quarters. And then the upside surprise. So when you look at retail sales, measured both increased more than expected in January, but December was taken lower. So when you're looking month on month, the size was a bit higher because they had a big write down in December, or readjustment in December. But again, on a nominal level, the numbers are still pretty good, which is why we want to look at things on a inflation adjusted component. And here's where you're seeing that PPI continue to run. Again, some of that tip of the spear when you're looking at where is inflation going and the CPI going to be. The January PPI came in higher than expected at 1% month on month versus the estimate of 0.5%. And then unchanged year on year at 9.7% versus the estimate of 9.1%. Core PPI came in at 0.8% versus the estimate of 0.5%. So again, you're seeing a lot of these pressures remain in the, let's call it the manufacturing gate price. And that's where they're going to have to continue to try to pass that down as they're seeing their prices at the company level remain elevated. And then finished goods PPI came in at 12.2% year on year in January, down from the peak rate of 13.3%. But you can get an idea, it's still near levels that rival the 1970s, which is something that, again, leading more towards that stagflation feel as we go into the summer months. U.S. PPI capital equipment continuing to go up. Goods inflation got a boost from capital equipment prices, which rose by most in decades last month. So again, some of this should come down a bit as it's the new year. People rush out, try to buy some new equipment. That should, again, slow down, which should pull down some of those numbers to a bit more comfortable level. Now, wage growth weighted series. So you have the overall unweighted, which is at about 5%, overall weighted 1997. Like, you get an idea. I just want to show all the different data sets, but the overall unweighted is the most important and gives you an idea that wage increases are at about 5% as inflation is running north of 7%. So you're getting an idea of, even though wages have obviously gone parabolic, so is inflation eating into some of those benefits. Which is why when you look at it on an hourly or weekly earnings level, even though some of it continues to catch up, and it'll continue to catch up, that's going to also feed into that inflationary cost, because as wage prices go up, the companies are going to try to pass that through. And again, you kind of get into that spiral, which they're trying to avoid and get in front of. So then when we turn to the erratic trend lines, this kind of gives you an idea of where compensation consumer prices are. And when you look at the 70s, during the 70s, wages and prices moved up in self-feeding spirals. And they want to avoid a wage spiral. And that's why we talk so much about where are wages, where are prices, what are companies doing, because this is how they have to try to manage to avoid these spiraling instances that would then create an out of control movement. Now, manufacturing output was up despite Omicron, and a lot of that was due to utilities. We had some big spikes, obviously, with some of them out of Texas and some others, but we will get some of that, normalizing, but still a positive to see on a normalized level. So then when you look at companies are investing in innovation, as the cost of wages goes up, as the cost of employment goes up, you're going to continue to see companies investing in innovation, automation, and you can see that this is something that, leading back to PPI on capital goods, that's something that we see as a bit more of a drift higher in terms of where some of those costs will be over the next few months. And then really over the next few years, and even though maybe you won't see the same price increases, this also costs something. And that's why, and as inflation remains elevated, prices of goods remains elevated, this will also be inflationary at the corporate level. So now in the next segment, we're going to go deeper into consumer pressures and where we see that going over the next few quarters.